Hello everyone. Today we are solving a AAA pre-June 2026 mock exam question number one. This is a 50 marks question, so the ideal time duration would be around 1 hour 45 minutes. So let's start. First of all, we arrange the answer space. There is a spreadsheet usually with question one in case you have to do some maybe analytical procedures. So that we will keep here if needed. Otherwise, the main content will obviously be on the word processor. So we start with Exhibit 1 because we know that the requirements are always there in Exhibit 1. Question 1, which is the partner's email. So let's open it and read it. And according to the question, then we can add some headings. To audit manager from Roma Basel audit engagement partner. First thing to note here is that they are saying briefing notes. So without wasting any time, you create the format to from date, subject, and introduction. Then we have, if we see here, we have significant risks of material misstatements. So we can keep a materiality heading and then significant risks of material misstatements. And usually we have, this is the sequence usually. Here the marks are 20, so you can write just 20 here so that you know. And 20 marks, usually 20 marks would mean you take out 3 marks aside. So remaining is around 17. So it means you need around 5 to 6 ROMs here. Using only exhibits 2 and 3, evaluate and prioritize the significant risks of material misstatements. Evaluation and prioritization is always there in recent settings to be considered in planning the audit of Truffle Group for the year ending 30th September 2005. Using revenue as your benchmark. So materiality is based on revenue. We can just note it here. We will have to make a little plan in this question because it's lengthy, especially for the ROMs part. Then explain the matters to be considered and the procedures to be performed in respect of planning to use the work of component auditors. So matters to be considered and procedures to be performed in planning to use the work of component auditors, Napoli and company, and so I gave this whole thing as a heading. You could have copy pasted also. And this is for 6 marks. Let's put here 6. We can highlight the headings. Okay. Then we go on design the principal audit procedures, usual requirement. This is on planning area for group audits, and because there's a component auditor involved. And then principal audit procedures to be performed on the investment. Principal audit procedures on investment property. So there must be some investment property purchased by the group during the year, including procedures relating to the management, including management expert appointment related procedures. Okay, so this is 6 marks. So we have to talk about some procedures related to some management expert that they're planning to appoint, it seems. This is also for 6 marks. And then you have exhibit 4. So exhibits are to be noted. This is exhibit 2 and 3 just for remembering purposes, just to make sure that it stays in my mind. I'm just putting here 4, 5, sorry, 4, 5, 2, 3. And here it is, in the last one, it is 4. Discuss the ethical and professional issues from finance directors' proposals. Okay, so this is 8 marks on ethics, a usual requirement in question 1. And here we have, they're saying exhibit 4. So this is from something from exhibit 4. And then in the end, we do a conclusion. Okay, so this is our format. We can just fill in the details here. Audit manager. So now I'm the audit manager. So we'll put here audit manager. And here we can put Roma. You can copy paste also. Audit engagement partner, and subject date is same always 1st July 2005, and subject is Truffle Group. It's a group audit, and you have to talk about audit planning as usual. So this is your then let's read this part. I recently attended a planning meeting with the group finance director. So partner is saying to the manager, I recently attended a planning meeting with the group finance director of Truffle Group at which we discussed the group's operations, recent events, and financial performance during the year. I've attached background information on the group together with selected financial information from the draft consolidated management accounts. Based on analysis which I've done on this industry, it is appropriate for overall materiality to based on revenue, which we have noted. You will need to determine and apply an appropriate materiality threshold in your briefing notes using the information below. I require you to prepare briefing notes. Rest everything we have read, so no need to come back now to this exhibit. We've read it fully unless we forget something. Otherwise, we'll not open it again. Now, before we start anything, we have to read this background. Sometimes there is some very important information here. So let's read it. It is 1st July 2005. We are manager in the audit department of Olive and Company. So this is the firm of chartered certified accountants responsible for the audit of Truffle Group for the year ending 30th September 2005. Year end date is very important. The group, which is not a listed company. Now, this is a point to note here because it might relate somewhere to ethics. And year end also has to be noted 30th September 2005. We can note it in the intro. Um, because this can be important, especially in a group or the group which is not a listed company is an existing client. So this is an existing client, which means that new client related area cannot be discussed here. So let's go then. We are done with this. So we are not coming back to this part also. Now we are only focused on exhibit 2, 3 for ROMs and most probably these two parts also. And then 4 for the ethics part. So this is what we'll have to do. So we'll say we'll start with introduction. Introduction needs details from here, partner's email. So we'll say these briefing notes include planning considerations for the audit of Truffle Group for the year ended 30th September 2005, or year ending 30th September 2005. And these notes include an evaluation and prioritization of significant risks of material misstatements. Then secondly, um, matters to be considered and procedures to be performed on component auditors, Napoli and Tuscan companies, Napoli company and Tuscan company, comma, principal audit procedures on investment property, uh, including procedures on management experts and ethical and professional issues arising from finance directors' proposals. You can copy and paste also, but you have to be short and quick in this because this is mainly for the format. So this part is done. Now we go on to materiality. There is a financial information. It has to be based on revenue. So we can open this. There's some financial information here. But there's only 3 things given: revenue, profits, and total assets. Just have a look that just let's do an analytical procedure also. Revenue is increasing by 220 minus 190, 30 million revenue increase. Then profit before income taxes is increasing from 22 to 41. So 41 minus 22, 19 million increase. And then assets are also increasing from 165 to 240. So 240 minus 165, 75 million increase. So everything is increasing, which is a bit questionable if you think from an auditor's perspective, but there can be reasons for that. So we cannot be too quick in deciding something on that. Now, for materiality, you have to take the 2005 figure, which is 220 million for revenue. So we'll say here that materiality will be based on revenue, which amounts to $220 million. Uh, Materiality will range from, so you can put the range 0.5%, revenue range is 0.5% to 1%. So you can say 1% will become $2.2 million, 2.2 million, and 0.5 would become half of that, or 1.1 million. So this is one thing. Now, with regards to which one will be selected, we need a justification, and for that we have to wait. So I keep it pending, but I keep this range in my mind. My objective will be to find some reason for the lower materiality threshold, but if I don't find it, then I might have to go for something in middle or higher, but I have to wait for that until I read everything, because sometimes there's a very strong reason for lower materiality in the last exhibit. So you have to wait for it. We'll wait for the justification, but we'll keep this range in our mind while going through the ROMs. And we'll have to make a little plan for the ROMs, because we have to read everything first and note things and then convert them into points, because sometimes you find something very important at the end and it might be linked to the first point. So you have to make a little plan for risks mainly. Okay, so let's go to this exhibit 2 and 3. We need to go. 3 we have already seen, it just has 3 figures, so there's not much. So I think we'll find everything from exhibit 2. That's a good thing, because there's only one exhibit to look into. Just a bit bigger. Okay. Maybe we can increase the size here slightly as well. And in between we have spreadsheet also. Okay. Truffle Group operates in the casual dining and restaurant sector, owning and operating branded restaurants across Homeland. The group's strategy is to grow rapidly through acquisition of established restaurant brands and to standardize operations through centralized procurement and marketing. So they are growing through acquisition, which means they will be purchasing companies, acquiring companies. Okay. The group offers a loyalty membership scheme which has recently gained popularity and now accounts for approximately 10% of the company's revenue. Now, this is pointing towards ROM, because 10% of revenue. Let's read here. Under this scheme, for an annual subscription, members can dine at any of annual subscription is there. Members can dine at any of the restaurants and receive certain benefits such as priority reservations, discounts, and access to member-only events. Customers who are not members can pay to access a restaurant on a pay-as-you-go basis, walk-in customers, and takeaway. So this is, for me, it's a ROM, because revenue, it's 10% of 220 million, which will be around 22 million, which is highly material, and the other aspect is that this is based on annual subscription. And annual subscription means that there might be an advance payment and then services throughout the year, or benefits throughout the year, which is pointing towards performance obligation over a period of time. And the risk is that they might have recorded all as revenue at start. So this is one big problem for revenue recognition. And another thing is that they also have walk-in customers. Walk-in. Now, walk-in customers they're saying pay as you go. Pay as you go, which means this might be at a point in time. That means you pay, you receive the service. That's all. And walk-in customers and takeaway also. Yeah, you take the service and you pay. In a restaurant, you have a meal, you pay, you go. So at a point in time, quite reasonably, it seems to be at a point in time, which means some revenue over a period, some at a point. So there is a bit of a complexity here. Complexity means inherent risk. So I think this is a very strong point because it's highly material, 10%, and we can later convert it into our ROM. Now, the group holds significant food inventory, most of which is perishable. Oh, because it's a restaurant, so there's food inventory and it is perishable. Now, this immediately takes me to ROM because perishable inventory uh, points towards chances of uh, write down and obsolete inventory, expired. Now, during the year, supply chain disruption caused delays in deliveries to several restaurants. As a result, some seasonal inventory remained unsold at the year end. Seasonal inventory unsold, which simply means that this is, either obsolete or huge reduction in value because nobody will buy out of season. So, which means IS2 applies lower of cost or NRV, and write down might be needed, which might not. No additional inventory write downs have been recognized. No write down recorded. This is a clear, ROM, but there is a little problem here, and that is because in the data they gave us revenue, profits, and assets. They've not given any figure for the inventory, so it's not clearly. We're not clearly able to say that it's material, but it seems to be material because the reason is that their restaurant, all their inventory is food, and restaurants have a huge food inventory. So it's a valid point to put. We might not get all 3 marks allocated for maybe a ROM, but 1 or 2 marks we might be able to get if we discuss it properly. In January 2005, Truffle Company received a government grant, 5 million, to support the opening of restaurants in economically deprived areas. Government grant are a very common ROM. The grant requires the restaurant to remain open for 3 years, so this is a condition now. Otherwise, the grant becomes repayable. The full amount has been recognized as income in the year. This is not correct. Government grant. So, $5 million material and all recorded as income, whereas conditions met over 3 years. Conditions met over 3 years. So has to be recorded over that period, which means overstatement of revenue, of income. And obviously, if the conditions have to be met later, you can't record it fully, so it has to be recorded as deferred grant. So liability also understated. Yeah. So this can be an easy point here. The parent company, Truffle Company, operates restaurants in Homeland. The group has historically operated in Homeland, but during the year has expanded internationally. On 1st January 2004, Truffle Group acquired 80% of Bella Company, a casual dining chain. With 45 restaurants in Farland, Bella Company prepares financial statements to 31st August and is audited by local audit firm Tuscan and Company. So Bella Company. Yeah. One thing is they prepare financial statements to 31st August, and uh, the year end of the group is 30th September. So there is a problem here. And another thing is that it's a new acquisition during the year, and first time you will be doing consolidation. And the problem is year end not same. Even though the difference is just 1 month, when the difference is just up to 3 months, IFRS allows financial statements to be consolidated uh, if the difference is up to 3 months, but adjustment for that 1 month will be needed. And because there is a component auditor involved, uh, he might not be competent to do this, to perform review of this adjustment period or perform audit of this adjustment period. And also, he might not have experience of group audits before. So then it can be a problem. So a lot of things are there. And as on 1st April 2005, Truffle Group acquired 100% of Pomodoro Company. So now there's another acquisition. So now thinking about materiality, there have been some new acquisitions here this year, which means for our audit firm, this can become a serious risk because first time they will be consolidated. So this is a significant risk which affects your materiality. So I can put here that Truffle Group acquired new companies during the year, including Bella Company and Pomodoro Company. Uh, our audit team will be performing the audit, uh, or audit team will might lack the knowledge uh, of these new businesses, and therefore like the knowledge, the risk in this audit is very high. This is a major change in the this is a major change for the audit, and our audit team might lack the knowledge of these new businesses, and therefore the risk in this audit is very high, or it's very high. Uh, the lower threshold of $1.1 million will therefore be or should or will therefore be selected as the materiality level at planning stage. Okay, so this is over. Justification. I think this is a very strong justification. Pomodoro. Now, on 1st April, Group acquired 100% of Pomodoro Company, a restaurant group based in Nearland. The group finance director has informed the audit engagement partner that the acquisition price was favorable. Favorable means that they paid less. Uh, no, it was favorable for them. Yeah, he's thinking that we have paid a good amount, as increasing competition in the restaurant market in Nearland had led to declining profitability, and management of Pomodoro Company had therefore been actively seeking a buyer. Pomodoro Company prepares financial statements to 30th September 2000. So this is fine, 30th September, and is they are also audited by another component auditor. As part of the acquisition of Pomodoro Company, the group recognized goodwill of 22 million and a brand of 14 million. Management considers brands to have an indefinite life and has not amortized it. No impairment review has been performed, as management believes future growth plans support the carrying values. Uh, Both overseas subsidiaries operate independently with local finance teams and accounting systems. Group management has limited experience of overseeing overseas operations. Pomodoro Company has some issues, and the issue, first of all, is that the company is facing increasing competition, declining profitability, and still they recorded a goodwill of 22 million. This means they have paid a value significantly higher than the fair value of assets. So what we can say is Truffle Group might have overpaid for the purchase, as goodwill is significant at $22 million. Um, you can say 10% of revenues. The other aspect is this, and because what is happening is there is increasing competition and declining profitability. Therefore, this means that goodwill might actually be impaired by the year, impaired significantly by the year end, but no impairment done. Okay. Uh, so this is one very important aspect, and that can mean obviously assets being overstated. Another aspect in this is the brand. So this was, you can say, goodwill, and this you can say Pomodoro Company brand. Now, brand is also 14 million material, and again, there is an increasing competition, declining profitability. Uh, so that means brand might be impaired. Another question that comes to my mind is that, yeah, might be impaired, and uh, it has indefinite life. One question, let's put it here, that they have defined it as an indefinite useful life, but this is subjective, and you know, assessment might not be correct, which is a risk. And also, if it is indefinite life, then impairment needs to be performed every year as per standards. So, which is not done. And therefore, this might be impaired as well. And remember, the acquisition happened on 1st April, year end is 30th September, so there's some time gap, which means definitely impairment might have been there. Most overseas subsidiaries operate independently with local finance teams and accounting systems. Group management has limited experience of overseeing overseas operations. Um, yeah, this mostly is because when they say they have limited experience of overseeing or overseas operations, that mostly is pointing towards a business risk. But there can be a link here that they might not be overseeing the finance teams properly and the accounting might not be done. So this is a point which we can keep in mind. But let's go to others if we don't find anything else, because we have got 1, 2, 3, 4, 5, 6 points here. During the year, 6 million was spent on developing a new IT system for managing customer reservations, loyalty memberships, and online ordering. Developing refers to development costs. Developing a new IT system and online ordering. A further 7 million was spent on research and development into automation and robotics. So, development of IT system, they spent 6 million material, and then further R&D costs on again automation, robotics, uh, another 7 million material. Capitalized, and these costs have been capitalized as intangible assets. All have been capitalized. First of all, the development of IT might not meet capitalization criteria, and R&D includes research that cannot be capitalized. Okay, because there's a criteria in IS 38. You can put here IS 38. Yeah. These costs have been capitalized and all being amortized. Another issue, amortization over 15 years. Subjective, useful life. Um, how it has been determined, questionable. Then the other aspect is that 15 years seems too high for IT. So this might not be there. And all cannot be amortized over the same period. Like IT system might have a different life, and maybe robotics or automation might have a different life. So this does not seem correct. So it might be misstated, meant in amortization. Most probably they've recorded more amortization, sorry, more useful life, which means lesser amortization, which means higher profits and assets. Higher profits and assets. In October 2004, again during start of the year, following the disposal of a significant freehold restaurant site, group purchased a building Saffron Square as an investment property for 7 million. Investment property, 7 million is material. The property is a retail development in the country's capital city. The group is going to appoint an expert to provide a valuation of the property, and an initial estimate of the increase in fair value of 1.2 million has been included in the group's financial projections for. So yeah, fair value is subjective. Investment property, 7 million material. Also, the increase in fair value, $1.2 million is material. Then the matter here is that yeah, how the fair value is determined. Expert also, you can say professional competence, independence is in question. And then fair value is subjective. Right? Okay. So yeah, fair value is subjective, and uh, it might not be correct, so might have been overstated. Okay. Yeah. So I think we've got a lot of points on significant ROMs, and we have finished this exhibit 2 and 3 also. So which means we can write on them, and then we'll go on to the other points. So let's write this, and then we will go on to the other parts of the question. So let's start with revenue. We can call it revenue recognition because this seems to be an issue of revenue recognition. So we'll say that yeah, the revenue related to annual subscription, loyalty membership scheme uh, amounts to prox 22 million at 10%, which is highly material. Then we will say that the model is annual subscription based, which means there will be, there might be advance payment, uh, and then the customers get benefits throughout the year. Uh, this uh, means the revenue should revenue might have to be recognized over a period of time, uh, and there is a risk that group the group recorded all revenue at start, leading to overstatement of revenue and profits and understatement of liabilities as in bracket as a contract liability would have to be recorded uh, until the performance obligations are met. The revenue might have to be recognized on this performance obligation. Okay, this is one thing. Then another area in this is that there are also walk-in customers. There are also walk-in and takeaway customers on a pay-as-you-go basis. Uh, this might mean that the revenue related to this area uh, this means the revenue related to this area might have to be recorded at a point in time uh, as per let's mention IFRS 15 somewhere here. As per IFRS 15. Okay. And now at a point in time, uh, this means uh, group uh, has a complexity in recording revenue, as some revenue has to be recorded over a period of time, and some revenue has to be recorded at a point in time. And complexity creates an inherent risk of possible errors, misstatements in recording revenue. Okay, so I think that's enough for the revenue recognition part. Now we go to inventory. We said that the group holds perishable, significant. Let's put the word significant, perishable inventory, uh, significant food uh, related perishable inventory, um, and some of the inventory was unsold at the year end and it was seasonal inventory. Let's put here some of the seasonal inventory was unsold at the year end, which means it might be obsolete or its value would have reduced significantly as the season was over. And being food, it might expire as well. IS2 requires inventory to be valued at lower of cost or net realizable value bracket NRV. Uh, and if NRV is lower, which might be the case here, then a write down in the value of inventory is needed, but management has not recorded any write down. This can lead to overstatement of inventory uh, and understatement of expenses, leading to overstatements of assets and profits. Okay, then we go to government grant, $5 million. So we'll say the government grant received by the Truffle company amounts to $5 million, which is material. All of this grant has been recorded as income by group, whereas the conditions for the grant have to be met over 3 years as per IS 20. Grant has to be recorded as income as its conditions are met. Uh, this means there is a possible overstatement of income. Overstatement of income. There is a possible overstatement of income and profits. Also, the grant is repayable if conditions are not met. Which means if the conditions have not been met by the year end, the grant was supposed to be recorded under liabilities as a deferred grant, which has not been done, possibly understating the liabilities in financial statements. Okay, now we go to Bella Company, new acquisition. Bella Company is a new acquisition for the group, and the year end of Bella Company is not same as that of the group. So we can put the year. Here it is 31st of August, whereas group is 30th September. IFRS allow financial statements to be consolidated if the difference is up to 3 months financial statements to be consolidated in this case if the difference is up to 3 months, but adjustment for that 1 month difference will be needed. Now, another aspect is that the component auditor is involved and they might not be competent to perform audit of the transactions in this adjustment period of 1 month, or they might not have experience of group audits. This can lead to material uh, possibility of material misstatements in the consolidated financial statements. Yeah, so this is one thing. Now, Pomodoro Company, goodwill. Pomodoro Company was also acquired by the group during the year. Truffle Group might have overpaid for the group as goodwill is significant at 22 million, 10% of revenues, in spite of increasing competition and declining profitability. Goodwill might actually be impaired. Let's put the word material here also. Goodwill might actually be impaired significantly by the year end due to possible overpayment and worse market and profitability conditions. But no impairment has been recorded by the in fact they said here for Pomodoro and please, yeah, no impairment review has been performed. So this is not correct, but no impairment review has even been performed by the group, whereas relevant accounting standards required goodwill to be tested for impairment at each year. Now, brand, here we can say this can lead to overstatement of goodwill and intangible assets and understatement of impairment expense, leading to overstatement of profits. Pomodoro Company brand. The brand recognized related to Pomodoro Company amounts to $14 million, which is material. Brand has been considered by management to have an indefinite life, useful life. It is not clear as to how that assessment has been made. It is subjective and therefore assessment might have been incorrect or might be incorrect. Being considered. might be incorrect. There is increasing competition and declining profitability, which means brand might be impaired as well. Uh, since brand has indefinite life, uh, standards, accounting standards require it to be tested for impairment each year, for impairment each year, which has not been done. Not been. So this can lead to overstatement of brand and intangible assets, understatement of impairment expense, and understatement of amortization expenses. Uh, sorry, not amortization expenses. Understatement and understatement of impairment expense leading to overstatement of profits. Okay, this is also done. Now what is left? Development costs. So costs related to development of IT system capitalized by the group amount to $6 million, which is material. There are also R&D, research and development, R&D costs uh, related to automation and robotics amounting to 7 million, uh, which have also been capitalized, amounting to 7 million, which is material as well. Okay. The development of IT system might not meet capitalization criteria under IAS 38. Uh, okay. As it might not uh, generate future probable benefits. R&D includes research that cannot be capitalized, and R&D includes research that cannot be capitalized as per IAS 38 and has to be expensed. But the group capitalized that research cost as well. Okay. This can lead to overstatement of intangible assets. Also, amortization has been considered over 15 years useful life. This is highly uh, subjective. This is a highly subjective estimate, and 15 years seem too high for IT related items as the technology changes very quickly. Uh, so useful life might be incorrect, might be overestimated. Also, furthermore, all IT related items cannot be amortized over the same period, uh, as the system might have IT system might have a different useful life as compared to robotics. So this also means the useful life might not be correct. This can lead to understatement of amortization expense and leading to higher profits and assets, or leading to overstatements of profits and assets. Now, the last one, investment property. The investment property purchase value was $7 million, which is material. Okay, let's put it here. The increase in fair value of $1.2 million is also material. It is not clear as to how the fair value is determined. The determination of fair value is highly subjective and uses assumptions which might not be correct or justified. Also, furthermore, the management expert performing the valuation might not be competent and independent of the group, and therefore there is a risk of possible overstatement of fair value of investment property, leading to overstatement of assets and profits. As fair value gains go to P&L in the fair value model of IES, just to add to it, add more value to it. Okay, so we are done with our risks. I think we've written a lot. Now, what we do is that we go to matters to be considered and procedures to perform it, planning to use the work of component auditors, Napoli Company and Tuscan Company. Here, we have Tuscan Company for the Bella Company. They are the component auditor. They are the local audit firm. And then here we have Napoli Company for Pomodoro. They are also the local firm. So they're asking matters to be considered and procedures to be performed. So I'll list down some and then we can expand. I think this is a very general requirement. There's not much detail on them here. So what we can say is that one thing that we can talk about is the professional uh, qualification and membership. You might have to check. Then which ethical standards do they follow? Do they have in that local country, do they have proper laws and regulations on audit, and whether proper regulatory body exists over these audit firms in those local companies? And then we can talk some points about competence. Competence means, for example, do they have group audit knowledge? You know, and they also said procedures to be performed. So you can say that um, group audit knowledge. What else can be there in competence? Okay, what we can do is we can work on procedures. That means how to verify the professional qualification and membership. So you can say that, okay, here we can add to it that it inquire inquire on membership uh, of professional bodies, inquire on the membership of professional bodies uh, of these competent auditors through making them fill, let's say, a questionnaire, and then check the relevant register of members of those professional bodies to confirm that these component audit firms component audit firms are actually professional firms, okay, registered with professional body. And so first thing here would be that um, audit team should check the professional qualification and membership of these component audit firms in order to ensure that they are uh, having the professionalism uh, required to follow or to perform such group audits, and that they follow professional standards uh, while performing audits. Another point that we can add here is, so this is a procedure that procedure we can take procedures later down, also depends. Now ethical standards, yeah, it will be important to ask the component auditors to provide uh, in writing as to what ethical standards do they follow. Uh, do they follow the IESPA Code of Ethics or any other code? If they follow any other code, then that code has to be assessed to ensure that they maintain uh, ethical requirements of from an auditor. Laws and regulations on audit. Yeah, so it will be very important for uh, audit firm to check whether the uh, uh, check as to what laws and regulations apply to the audit firms in near land and far land and far land and near land, um, and whether the component auditors Napoli and Tuscan are following those regulations, uh, whether here we can add whether those regulations are strong enough for proper audit practice, and whether Napoleon and Tuscan are following those regulations. Also, it will be important to check uh, from the component auditors whether they are uh, regulated by a regulatory body in their country which regulates audit firms, because that can ensure uh, proper monitoring over the work of audit these audit firms, and can point towards quality work. Competence, it will be very important. Um, Competence also has to be considered for these component auditors, especially on whether they have group audit knowledge and whether they have experience of performing group audits in the past. They can be asked to provide references of their past work as component auditors, as, uh, as component auditors for some other group audits. Another point here is independence. Management of Bella and Pomodoro have to be asked to if confirm whether they have evidence that Tuscan and Poly company are fully independent uh, firms and have no uh, connections to Bella and Pomodoro other than professional audit signed. Um, because this is very important, because otherwise their work uh, might not be reliable, as they might be favoring Bella Pomodoro. Okay, I think that's enough. Now, principal audit procedures on investment property, including management expert related procedures. Here they've talked about management investment property, that they purchased an investment property for 7 million. So maybe what I'll try to see is purchase agreement for the purchase of Saffron Building Square, uh, to confirm the transfer of ownership, uh, which is your rights and obligations, and to verify the date of purchase and the amount of $7 million, purchase amount of $7 million, etc. Now, the other thing, obtain and inspect the purchase agreement. The other thing that we can say here is, with regards to 7 million, that verify from the bank statement, um, verify, or you can say obtain and review the bank statement to confirm that $7 million was actually paid during the year for the purchase of saffron spare. Then what else we can say? The group is so this fair value determination. But before that, let's talk about the expert because they asked about the expert. Another thing we can say about the property, maybe if we want to make one more on property, is that physically inspect the saffron square property to ensure that property existed with the group at year end. So this is your existence, which we have checked. Now we go to the expert. So they said we have to check the expert. Again, you have to check his professionalism, his competence, his qualifications, his independence. So what we can say is that uh, ask the management to provide proof of the independence of management expert in order to ensure that he has no previous or existing connection with the company in a way that he may favor the company in valuation. Another thing that you can check is ask the management to provide the proof of to provide details of professional membership management to provide details of professional membership of the expert and verify from the register of members of the relevant professional body to confirm he is professional, to confirm he complies with professional standards while performing valuation. Okay, now let's make one more procedure on the fair value itself. That means obtain the valuation documentation where the fair value increase of $1.2 million was determined to assess the assumptions used for reasonableness. Okay, so I think we've got 6 points. Now we go to our, I'll just delete this exhibit 2, 3 thing. And here also we can delete exhibit 4. And now we have only the ethics part left, which is related to exhibit 4. So let's read from there. What does it say? It says the group finance director has asked your audit firm whether it can provide the following additional services. An additional service to advise management on how to measure and prepare. Advise on how to measure and prepare social and environmental information. Okay, so this is one aspect that is there, which they're asking, which is required by new regulations. The Homeland, the information will be published on the group's website and submitted to the relevant regulatory authorities. The social and environmental information includes metrics such as food waste levels, energy and water consumption across restaurants, charitable and community initiatives, employee diversity and well-being, and supplier sustainability measures linked to the group's central procurement strategy. So they are very technical. I'm putting a point on competence here because there are KPIs sort of stuff which the audit team might not be aware of. Then another thing, it has been suggested. Okay, one more thing that is coming to my mind is a management threat, because how to measure is the role of management, and even prepare. These words are sort of questionable because if everything is being told by the auditor and they just implement it, then this creates a management threat, and this is a serious threat, cannot be avoided actually, cannot be avoided. Another problem in this is that this also leads to why it's a management threat. We also have to justify that because auditor has a responsibility on other information, and this might go into other information, and he might be responsible to perform some review on this, and find material inconsistency as part of his audit, as part of audit. And because it is as part of audit, so he cannot then have a management threat, because then he cannot assume management responsibility. So these are the things which will be, I think, there with regards to management threat. The other aspect that is there, it has been suggested that in order to pay for this additional work, the agreed audit fee will be increased by 20%. Audit fee cannot be increased. Audit fee increase not allowed. It can be a separate assignment, but it cannot be as part of the audit fee, and will be increased by 20% if no issues are identified by the regulatory authorities. If no issues are identified by the regulatory authorities, this is a contingent fee subject to no issues by regulatory authority. This is not allowed. Not allowed. So for audit firms, okay, even if it is a not listed company, even if it is a non-listed company, even if not listed, because this creates a significant, um, you know, um, self-interest. Right. So I think we've got 4 points here. Let's go to the next part also. We might have to write something there as well. An initial service to conduct a detailed review of certain internal controls and to recommend improvements. So a review of internal controls and and recommendation of improvements. So this is another service that they're asking. The internal controls to review include controls over inventory management, cash handling, and restaurant size, task scheduling, data security, not all of which are directly related to financial reporting. Self-review, because uh, some are going to financial statements, and this might be significant if material. Uh, if not material, then you can use separate teams and EQR. We can say that here also there can be a management threat if recommendations are implemented as it is. Okay. Here we can say if material, it's significant. If not material, um, you know, because it's a not listed company, so separate teams and EQR will be fine. And also taking management uh, consent on responsibility. So something like that. I think we've got all points. Now let's quickly convert them and then we'll close it out. So we'll say that um, and prepare social, and so let's remove this not listed. Firm will have to ensure that the team on this assignment is competent, because this assignment needs work on social and environmental related KPIs, like uh, I'll just pick one example: energy and water consumption, food waste levels, which might not be a normal skill of an audit auditor. Okay. So this is one thing. The other thing is management threat. So this assignment can lead to a management threat because of measurement and preparation of social and environmental information. Uh, you know, it becomes management threat because auditor will be taking responsibility of the management, and or taking role of the management on one side, and on the other side, uh, audit team, same auditor, same audit team, because same audit team will review the this information as part of annual report and assess for any material inconsistencies and look for any material inconsistencies and report them in audit report. Uh, this is a serious threat. This management threat is a serious threat and cannot be avoided uh, unless management gives in writing that they take ultimate responsibility for measuring and preparing this information. And then audit fee increase. So increasing audit fee by 20% due to this service is not allowed because this service is a separate assignment and has to be charged separately. It should not affect the audit fee. Is not professionally allowed. Contingent fee, the fee associated with the service, with this service, is a contingent fee because it is subject to no issues by regulatory authority um, on the information published. Contingent fee. Contingent fee creates a significant self-interest threat and is not allowed by the code even for non-listed companies. Even for non-listed clients. Okay, now we'll say review of, so review of, you can say this service will create a self-review threat because the audit team will recommend improvements to controls which, if implemented by management, will later be audited by the same audit team. And the figures related to some of these controls are going to financial statements. Improvements to controls. Okay, let's write here if these controls are improvements are implemented by management, the figures related to some of these controls will go to financial statements, which will later be audited by the audit firm, by the same audit team, and they might be reluctant in finding problems in their own work. Okay, 1, 2, 3, 4, 5, 6. I just want one or two more. This can also become you can say, also become a management threat if recommended or implemented as it is by the management. And that would mean that uh, this service might not be acceptable in that case. Uh, if it is, if there is no management threat, uh, and the amounts in financial statements relating to controls recommended are material, then even it becomes a significant threat. Uh, but since group is not listed, this threat can be reduced to acceptable levels by using separate teams and engagement quality review. Hmm. So if there is no management threat and the amount in the financial statements relating to controls recommended are not material, then even then, since the group is not listed, this threat can be reduced to acceptable levels by using separately. Okay, so this is over. Now, last point, that these briefing notes cover the major planning considerations for the audit of Truffle Group. The uh, risks, the most significant risk of material misstatement relates to uh, acquisition of Pomodoro company, as there are huge figures for goodwill and brand involved, which have not been impaired, possibly, which have not been impaired. Uh, the next significant risk would be the investment property uh, measurement fair value determination, as it involves subjectivity and is highly material as well. Yes, so this is your point on conclusion. So this question is over, and that's your answer for question one.